Good morning. This is active retirement investing. We're going to get started right now, and there'll be people coming in, so that's okay. I am Shaniqua Wicker. I am the instructor assistant and also the tech host for this class. Up here, we have a disclosure. I just wanted to take a minute and read the disclosure. So, this seminar is being presented for educational purposes and is not intended to take the place of specific financial advice. What is right for one individual may not be appropriate for everyone. You are encouraged to seek professional advice in areas of investing and retirement plans, insurance, taxes, banking, real estate planning, as appropriate to evaluate your unique situation. Many of the statements given throughout the class are our opinion and should not be construed as recommendations for any specific security or investment strategy. Any references to previous investor experiences are not representative of all investor experiences. When reviewing the historical performance of various investments, keep in mind that the past results are no indication or guarantee of the future performance. Of course, always read everything. And due to our time constraints and varying degrees of student knowledge, some of the topics discussed may be covered in simplified terms. We do encourage you to refer to our textbook, Active Retirement Investing, for more detailed information. And anything else that you might want to look up that is information provided in our book. And we welcome students of our seminar to seek our opinion and services outside of the classroom if you choose. However, we will not solicit business during our program. Contact these regulatory agencies for more information about the role and responsibilities of broker-dealers, registered investment advisors, and their representatives. And we have the Financial Industry Regulatory Authority, FINRA, here. There's a telephone number and website. And we also have the SEC. You can see their telephone and their website. By remaining in this class, you acknowledge that you have read the disclosure and understand the content. And of course, you may request clarification of any part of this by just giving us a call. And our phone number is 916-863-1266. Thank you. And I just wanted to say that you'll find a few things on your desk. So let me go over that first. What is on your desk? So one of the first things you'll have is a stress ball. You can squeeze it if you're stressed. Another thing you have on your desk is a FINRA magnet. So feel free to have that. The next thing you have is a notebook, journal, and a pen. You can take any notes that you'd like on this notebook. And this brochure right here is actually our class outline. And then on the back, we have a brief instructor bio. If you open it, you'll see our classes laid out by date and then what we'll be going over each class. And if you miss any class, that's okay. There's no like attendance policy here. We also are recording each class, so they'll be made available to you hopefully within a week after the class. The next thing you have is a little broker check insert, and it just goes over how to check on your advisor. The next green one you have is your investing knowledge quiz. You can go through that and see how much you know. The next thing is a crime prevention guide. So it just goes over how to prevent crime. And the last thing you have is our textbook we'll be using, which is Active Retirement Investing. If you took this class in the past, there's been a few updates to it, so you might want to keep this book. And if there's anything on your desk that you don't want, you can just leave it at the front. And up front, we're usually going to have extra materials, and we'll try to bring different and new resources each class. And we also have water, we have candies, we have pens. And if you didn't sign in, I'm going to pass this around. If you didn't sign in, just find your name and initial and tell us how you heard about us. And I will do that now. I think people in the front signed in. Is there anyone who hasn't signed in? Okay, I'll start. Oh, you too. Okay, I'll start over here and just pass it down. Thank you. And there's a pen for that. All right. So next, we are going to just go over the emergency numbers for campus. Hold on. Hmm. Okay, great. So in case of emergency, here's the police number and a few other emergency numbers. And here are some other university numbers you can call, and there's some outside agencies. So you can take a screenshot of that if you want to. I'll just leave it up here for a minute. All right, and I'm going to do the other slide again. And next, we're going to play a short 30-second CPR video. If you don't know how to do CPR, here it is. It's always good to know how to do that or to get a refresher.
Your hands can save a life. It's 3 easy steps. Step 1, check. Tap the victim's shoulder. If you don't see any breathing or movement, it is serious. Step 2, call 911 immediately. Step 3, compress. Interlock your fingers. Use the heel of your palm to push down in the center of the chest. Know what to do. Check, call, compress. Save a life.
All right, I'm just going to go back to this slide. The next thing, an announcement is I'm assuming all of you signed up through Renaissance. And as you know, if you want to bring your family, your friends, your loved ones to a class, they can go for one free Renaissance class to any class. And if you bring them to our class, they're going to get a free book and a free everything that you got. So they're welcome to come anytime. And if you have any questions, ask your question, and I'm going to try to come around with the mic as best I can. It's my first time trying to come around with the mic, so thank you for your patience for that. And we will also try to bring extra books next time. I didn't bring a lot extra this time, but if you want to take one for your family or friend, they're free. You can take what you want. And if you need a restroom break, you can go out and use the restroom. I think there's restrooms on this side and that side, but I don't know if it's men's or women's. So, okay, women's is that side and men's is that side. And this class is from 1 to 2:30, but our instructors are here a little bit before class and then till about 3. So you can bring any questions you want. You can bring in any kind of statement you want, and they're available and free to ask questions. And now I'm going to turn it over to Bill to introduce himself. Thank you.
My name is Hunter William Bailey. I'm shy. Hunter William Bailey. I go by Bill in the class. I've been doing this class for about 10 years. So it's evolved quite a bit. These two are doing a fantastic job. It used to be handwritten notes or pull something out of the paper and here's what's going on. So they've done an incredible job. My son Nash is going to run the class. I'm his assistant, but I just wanted to cover a few things. The purpose of the class and the book is to help you manage your own investing if you want to do it, or if you have a family member or you hire somebody, we want you to know how they should be doing things. And our outline, the way the book's been written, follows an ethical and an administrative process that follows the SEC and FINRA and all their rules. And the industry now should get away from sales techniques and tactics and should be more like being a CPA or an attorney or something. So we want to cover the basis of what you should be looking for. But the class is here to teach you how to do your own investing. Or if you have a family member or an advisor, make sure you know what he or she should be doing. What's appropriate, what's inappropriate at that point. And you go from there. And if you're not sure what to do after the class, you'll have some ideas. And if parts of it are a little too technical or it just goes over your head like it does for me sometimes, and I'll be asking Nash questions. He has more certifications than I do, more training. So don't be intimidated. You can go back to the book, but you don't have to know how to do the management. We just want you to know how to protect yourself, whether you do it or you have somebody else do it. So we want you to gain awareness of the process. He has a process that goes from beginning to end. But in the beginning, just like any doctor giving a physical, he's got to go over the financial planning areas to make sure you have a better understanding of estate planning, taxes, things like that. Then he'll get deep dive into the investments as he gets going. But as we have to do with a client or you have to do with yourself, he'll show you how to evaluate where you are and what risk level that you might consider taking with which investment. Assuming that everything's legitimate investing, stocks, bonds, exchange traded mutual funds, still you can get into trouble if you don't really know what your personal risk tolerance is or your time frame. So he'll cover that. Obviously, questions are extremely welcome in this class. We don't have to follow these the slides. They're there to keep going in a direction in case people don't ask a lot of questions. But if you ask questions and they're very legitimate, no matter how basic they are, then we want you to ask the questions. You can just raise your hand and we'll be more than happy to do it. And as Shaniqua mentioned, at the end of the class, we'll stick around and answer any questions. We can do a little coaching at that time. You can take Nash over into the corner and ask him personal questions about your finances, show him a statement or something. If he's busy, you can pull me over and we'll both coach you a little bit at that point at the end of the class if you want to. Some people like to bring their investment statement, hide it and say, what do you think of this or that? We'll give you some pointers on whether the funds have high fees, commissions, and all that kind of stuff or not. But at the end, the last half hour, we'll both stick around. He's the expert, but I'll assist everybody. I've got 44 years of experience. He's got 7 hard-working years of very technical certifications and education, but he's been trading since he was 10. Right? Just before the market tanked in 2008, he bought a portfolio of stocks, but Dad kept adding to it. So then he went to exchange traded funds and a few mutual funds, done very well. And so he's 27 now, but from birth, actually used to come into the office, the same office we're in now, from birth. So he's been in the business his whole life, and he spent the last 7 years getting the most advanced levels of training. But I've got advanced levels as well that his is higher. So ask any questions, and we're here for any coaching at the end, no strings attached. We want to make sure that everything's relevant. So even if you hear things that aren't relevant, if he's talking something about financial planning, disability insurance and that stuff, and you think, well, wait a minute, I'm retired. Well, we want you to learn that so you can pass it on to your kids, or if, well, nobody's here is old enough to have grandkids, but if you have grandkids,
Right.
we want you to coach them, pass it on, right? And if you want a new career, we'll help you get into this one. But everything that we do, it may not relate specifically to you, but pass that on. So family and friends, as we mentioned, are welcome to come in partway through the class at any time. I'm here as an assistant, and if I have any information or I ask any questions, I'll be available, and I'll be working on the class and business stuff on the computer. So I'll turn it over to Nashoba Bailey.
Okay. Hi, everybody. Nice to see you all. A lot of new faces. I'm an advisor with Wealth Strategies, our firm that we run together in Citrus Heights. And I have, as he mentioned, spent a lot of time training, and I have now been in the business for a couple of years running my own little book. And so I'm a chartered financial consultant from the American College of Financial Services. That's essentially just a lot of training about in-depth financial planning, investment planning, insurance planning, estate planning, and those things. There's also a couple designations that I have from the Institute of Business and Finance, such as being a certified fund specialist, certified income specialist, certified tax specialist, certified estate and trust specialist, and certified annuity specialist. So I've learned a lot of things over my time, and I feel like I'm able to package a lot of this information in a way that I can deliver it in a way that people can understand in a more simple way. Because I find that this industry, as a lot of things with finance, they tend to overcomplicate a lot of things, especially for the end consumer. And it makes it very confusing to figure out what it is that you need. And it makes it also very easy to get sold an overcomplicated product that you don't actually need. So that's one of the main things that I like to help people do, is just really help them understand what it is they need and what goals they're trying to accomplish, what objectives they're trying to fulfill with the products that they have available to them. Because as we've mentioned, there's a lot of sales tactics in the industry. There's a lot of overcomplicated products that you just simply don't really need to be using. There's a lot of things, you'll pay a lot of fees, a lot of commissions for things that we just personally don't really think are necessary. So, as I mentioned, our firm that we run is Wealth Strategies, and we've got both of us as advisors. And if you ever have any questions just about generic things, we're not soliciting that you become clients here. We're just wanting to offer our knowledge and our experience and any answers that we might have to your questions. If you want to see the recordings of the class, they'll be available on our website, hunterwilliambailey.com. And you can also always call our office at 916-863-1266 if you have generic questions or you want to meet with one of the advisors, him or myself. Yeah, do we have like some business cards we can pass out or something? Okay, yeah, we should have them on the book as well. Okay, so to get started with class 1, we'll just kind of talk a little bit about the title of our class, Active Retirement Investing, and kind of what we are referring to when we talk about that. So I notice a lot of times when I'm speaking to people about retirement planning or retirement investing and things like that, is that they think that if their situation's not necessarily too extravagant and complicated, that there's nothing really to do after you've finished saving. And while, yes, the majority of the work is behind you, there is still a lot of things for you to be doing when you reach retirement or leading up to retirement or post-retirement at that point. There are many things that are important to consider, such as protecting the assets that you have worked so hard to build, and really just making sure that the plan continues to serve your needs and you don't run adrift of the direction that you're trying to go. Because there are a lot of things that can really threaten a plan. There are things that can threaten a retirement. Some really extreme examples might be a lawsuit or a really intense medical event that has a lot of costs associated with that. Long-term care really draws down assets very fast. It's not uncommon to see long-term care costs of $20,000 to $30,000 a month. And that's a lot of money, especially if you don't have a really large pile of assets or you don't have a long-term care policy. So there are risks like that that we want to make sure that we are covering for. And those are a lot of the things that we're going to mention and address in this class. So as a little bit of an introduction, like he's mentioned earlier, whether you do everything yourself, you just want to check on the person who's doing it for you, or you want to figure out, where do I go to get the answers? Where do I go to get assistance? What kind of questions am I going to be asking? What sort of solutions am I looking to have provided for me? We're here to sort of educate you on that process. Again, we're not trying to solicit business. We're not trying to sell a product. We just want to give you the information so that you can do it yourself. And oftentimes what we find is, when you get all the information of everything you need to do, you end up really realizing you just don't really want to do it because it's a lot of work and it's a lot of time. And that's what you're trading that fee for, is to save that time back and invest that into enjoying your retirement. So a couple things that we're going to cover in this class. We're going to talk about goal setting, prioritization, and quantification. So when we talk about goal setting, a lot of people will, again, they'll think about that, creating that bucket of assets to use in retirement. But we also need to look at goal setting as spending those assets in retirement, protecting those assets in retirement, or passing them on to beneficiaries later. Everything that we want to do with our assets, everything that we want to do with our lives should be part of our financial goal setting, prioritization, and quantification, knowing dollars, years, all these sorts of things. We want to be able to put hard numbers down on it, because then we can really concretely build a financial plan that's going to push us in the right direction. So basic risk management and insurance planning, we'll just talk about some common pain points and some things that we tend to point out whenever we're talking with our clients. For the most part, a lot of people are good about having the right insurance coverage. You're good about having car insurance. You're good about having health insurance. But a lot of people aren't aware of some extra risks that they might not be covering for, things that an umbrella liability policy might cover for, or other things of that sort that we'll get to later. Mission critical estate planning topics. It's just the really important things, like making sure that we know where assets are going and how they're going to get there. Because what we don't want to do is leave that up to somebody else after we've already passed. We don't want somebody making decisions with our assets when we probably already had an idea of where we wanted them to go. Even if it's very generic and it's very simple, it's really important to have documents that state what is going to happen with assets after your passing or even during your lifetime. It's really important to have the structure in place so that things don't get slipped through the cracks and we don't end up in a situation where possibly the state is deciding for us what's happening. Because oftentimes that can be just the incorrect decision. It's very public and very expensive. And there are some things in there that we want to avoid, and we'll touch on that later. So we'll also talk about our 3-phase approach to financial planning. So instead of writing a 100-page document with this super long appendix and all of these terms that you want to look at and tons of projections, we just really like to break things down into simplicity. We really like to look at just a couple things, like initially touching all your bases on financial planning, making sure that you know where your assets are going with estate planning, you know how your assets are protected with insurance planning. And then when we move on to a second phase, we like to do our investment planning to make sure that all of your assets are allocated in a proper way. And then on our third phase, constantly looking back at our plan to make sure that it stays in line with what it is we want to be doing. So we're also going to cover in-depth investment analysis. That's what we really specialize at Wealth Strategies. We specialize with asset management, really hedging that downside risk and just really making sure that we have portfolios and buckets of assets that are really serving you and are going to continue to serve you through your goals and are not going to put you at extra risk that we're not looking for, but also are not lacking in the ability to grow to provide for our needs. So there are a lot of things that we'll talk about there, especially in terms of looking at risk, different risks of different products. That'll be something we get into. That will be a very big part of our class here. We'll talk about a guide to diversification. So after we learn how to do a lot of our investment analysis to really evaluate different products and evaluate the different things that we want to put in our portfolio, we'll talk about how we can best combine these products to create the lowest risk, highest return, probable combinations of assets in order to really push you towards your goals and not expose yourself to any individual risks too much. Then we'll talk about post-planning activities, kind of a callback to your third phase of our financial planning approach. We just want to make sure that you're doing the things that you need to do to keep up with your plan. Like I mentioned right at the beginning, a lot of people think that once you get to having built the assets, I'm done. I did it. I did everything that I needed to do. I saved what I needed to save. I invested as I needed to. But there's a lot of things that you want to do afterwards to make sure that things stay on track. And then lastly, at the end, we'll talk about evaluating professionals, their services, their compensation, how that's structured, how that works, and how you might start looking for somebody, regardless of who it is or how you want to pay them. We'll talk about the different structures of how that's available and what you might be looking for when you're moving forward. So we'll have a couple different goals that we'll be looking at. There's a couple different things that we can do. Obviously, some people want to just maximize their retirement income, take everything that they've got and really milk that cash flow and have a lot of income to spend in retirement. Reducing income taxes is a concern for a lot of people. Some people they really don't like giving their money to Uncle Sam. And trust me, I get it. I really get it. When you're paying those 30, 40% taxes, it just feels like I did all this work for that. You're going to take almost half of my money. So that's something that you can look at, is reducing your income taxes. Now, at the end of the day, we're not going to get away from paying the taxes, but we can minimize some of our liability there, and we can increase some of our efficiency to make sure that we're not giving up dollars that we don't need to give up, and we're only paying our fair share that we are required to pay. Inflation protection is a really common thing that we talk about a lot in investment planning, because that's a lot of why we're investing in the first place. We want to keep up with the pace of inflation. We want to keep up with the prices rising. That's why we put our dollars into the market, so that we can be carried with that inflation and hopefully beyond it to have extra purchasing power in the future. Funding children's education is a very common goal that a lot of people want to do. Obviously, that's why we have things like 529 plans, but there's some other ways that we can do that as well. I've seen a lot of talk recently that it might sometimes be a better move for parents and grandparents to really think about funding children's education from Roth accounts, Roth IRAs and Roth 401ks. There's a couple different reasons for that we can touch on some more later. Estate growth, just building that bucket of assets and continuing to make it bigger and bigger so that we know that we have a lot to work with when we get to retirement or to whatever goals that we're looking to fulfill, whether those are charitable or for beneficiaries or any of those sorts of things. Financing travel and entertainment, one that I like to encourage clients to do more often than not, because what was the point of building this giant bucket of assets if you're not going to spend it and enjoy it a little bit? Sure, it's great to leave your assets to your beneficiaries as well, but you did the work, you should enjoy it a little bit. So that's one thing that we really like to encourage, is that people actually spend the money that they saved this whole time. Distribution of assets, really that's calls back to estate planning, making sure that we have the right channels for the distribution of our assets, that the right people are getting the right kinds of assets, both for their sophistication and their understanding of how it might work, and also how it might impact them tax-wise or in any other way. Things like a spendthrift trust, or things like, you can put your money in a trust and then it immediately goes to the beneficiary. But if you have something like a spendthrift trust, you can have really, really particular ideas and requirements that the beneficiaries must follow in order to get access to their investments. So if you have somebody that you're not you really, really want to motivate them to go to school and get married and do all these things, you can have these really, really specific requirements in something like a spendthrift trust to make sure that they go on the right path before they get the spoils of your work. Protecting accumulated assets is also a very important goal, as I mentioned before. Part of our insurance planning, that's where something like an umbrella policy may come in, where we're really just making sure that we're not going to lose any of these assets to what are high severity, low frequency risks. Things that we don't think are going to happen, but just in case they do, make sure that we have a backup plan to protect us from that. So quantifying goals. Quantifying goals into attainable numbers is incredibly important, because I was actually just recently talking to a client about one of these things, and what they wanted to do was they wanted to bring their assets in, and they wanted to make sure that they had enough income for retirement. They wanted to make sure they could live and supplement and travel and all these things, but they had no idea what number that was. They didn't know how much income they needed. They didn't even really know what their expenses totaled to on a month-to-month basis. If I don't have that information, it's kind of impossible for me to create a plan for you, because if you don't know what you're trying to achieve, how can I know what solution you require? So it's really, really important that no matter what your goal is, whether it's giving $1 million to your favorite charity, having $100,000 a year in retirement income, or whatever the case may be, it's really important to quantify these things and make sure that you can really just have a hard number that you can look at, so that when you're looking at all of your assets, you can build that into the plan and understand whether it is actually feasible, or if there's something else that we need to be doing, or maybe we don't need to be taking as much risk as we thought. That's pretty common too. So turning cash flows into present value lump sums, that's a little confusing of a statement, but really what we're doing here is using a couple financial calculations that we won't go into detail on, but there are ways that you can think of your cash flow. Like, if I wanted to create that $100,000 a year in retirement cash flow, if I use a couple assumptions, like what kind of interest rate am I going to get on my money? What are my investments going to return theoretically? We like to use some historical numbers for those assumptions. What kind of inflation rates are we probably looking at? How much money are we hoping to have at the end of it? Do we want to spend it down to zero? Do we want to have $500,000 left at the end of our lifetime? All of those different factors are things that we can use and plug into financial calculators in order to give us an idea of how much money today we would need to come up with in order to fulfill those needs. So estimating the lifetime of a lump sum with distributions is pretty much just the exact opposite of that. And we might be taking a pile of assets that we have now. Maybe you have a $500,000, $1 million, $1.5 million retirement plan, and we want to think, how long could we make this last? So if we're looking at possibly what the returns have been averaging over a long period of time, and then we look at how much of a distribution are we looking to take every year? Are we looking at RMDs? Are we looking at something extra? All of these things we can also plug into our calculators and give us an idea of just how long we expect these assets to last. So it's really important to understand what kind of investor you are, because it's important to be able to just understand, like, when do you want to hire somebody and what should you be doing to make sure that they're doing the right thing for you? Or are you following the required steps to be your own professional? So if you do your own investing, you should be as qualified as the person you'd hire. That doesn't necessarily mean that you need all of the degrees and the certifications and all this stuff, but you should be about as educated as the person you'd like to hire is. Because if you're not, you're likely going to miss details and you're going to miss things that could make a really big impact. So one thing that I like to mention is to don't be afraid to delegate sections that you're not an expert in. If you're really, really good at picking stocks, great. Go right on ahead, pick your stocks, but you probably are going to want to have somebody else do your taxes. You're probably going to want to have somebody else do your estate planning. You're probably going to want to have somebody else take over your insurance needs, because you need to be specialized in what it is you're doing. So it's really important that to understand where your limitations lie and understand where your strengths are so that you can play to those things really strongly. If you're using an advisor, it's really important to check their background and see what they've been up to during their career, because it's unfortunate, but there are a lot of people who just don't know some of the things that their professionals have done in the past, whether it be, some maybe crimes of passion in their younger years, or maybe they just sold some investments that really were not suitable for clients. And do you still want to trust that person with your retirement assets and with the safety of your future? So the other thing that's important with using an advisor is being able to evaluate and understand their advice on a basic level. Yes, it's good to trust a professional, but it's also really good to make sure that you know exactly what it is that they're telling you. Make sure you know what kind of advice that you're getting so that you are able to not just follow it completely blindly and maybe have some idea of what the impact is going to be for you.
If you're using an advisor, how often would you recommend staying in touch with them?
So that is really going to depend on your situation. There are some situations where there's not going to be a lot of maintenance, especially there are periods in the plan where it will be different. When you're first starting with an advisor, it might be worthwhile to have quarterly, monthly meetings, depending on the goals that you're trying to accomplish. But on a maintenance basis, it would be at minimum every time something changes, have a conversation, no matter what. If anything changes, if, like really anything at all, if anything changes in your situation, it's a really good opportunity to have a conversation with your advisor, because that's information that may change your plan. So that is what I would say, that's base level. Absolutely, no matter what, whenever things change, just give them a call. It may be important, it may not be, but you don't know until you have that conversation with them. So that's what I would say. Corner back there.
Based on different, that's okay. You hire your advisor based on investment, like wanting to actively invest versus no, we agree on a plan, is what we stick to until we say, okay.
Sure. So
Can you summarize the question before you
Yeah.
answer so we can hear
yeah,
another
so the
recording?
question
Thank
was really kind of asking, can you hire based on, I guess you could say, different behaviors, like are you going to have an advisor that's going to actively manage your investments in perpetuity and just change things as they see fit? Or can you also go with somebody where you're going to have a designated plan and then we're going to meet again and make sure that we agree on the next change continuously? All of those are valid options, although I would say that for the most part, plans are not going to be necessarily static, but they are definitely going to be very concrete, and they should not just be, it shouldn't be too easy for things to change. What I would say is it will also depend on the way that an advisor is going to handle your investments. So for example, you will have a lot of advisors that don't actually manage the investments in-house. They'll cart this off to somebody else, some other investment firm, could be BlackRock, Fidelity, Vanguard. There's a lot of big companies that do asset management for these advisory firms so that they can specialize more on the client communications, estate planning, insurance planning, and things like that. Versus you'll have a firm that's more like us, where our specialty is more in the investment planning. So we'll do our management in-house because that's where we feel our strengths lie. So it really is just going to depend on the style of the investor or the advisor, but also at the same time, if we're taking on a client, the risk level's not going to change, even if what's inside the portfolio might change a little bit. The overall plan should stay relatively similar moving forward, unless we really know that there's a big change, like a lot of assets have come in and now we don't need to take so much risk, or there's another big expense and we need to make sure that we fund that. It really will mostly depend on your specific situation and the style of the advisor. Hopefully that answers.
Answer would be yes. Nice wants to break it up. Some can do a plan, some do the investments, but if one's doing the other, they don't know what the other is, then it's not as efficient, but it's possible you can do it.
So, seeking answers. If you're not using, or if you're looking for answers from other people, whether it be advisors, friends, family, it's really important that you know how to sniff out the garbage and make sure that you understand what's too good to be true, understand what is just not right for you, And that suitability, keeping that suitability top of mind, understanding what is a suitable product for you. You might be a really simple investor and understand, I just like a couple mutual funds, couple stock funds, couple bond funds, don't make it too complicated. But somebody might be trying to sell you alternative investments, some kind of really fancy funds that you just don't really understand, or insurance products that are really complicated, that are making a lot of promises, a lot of downside risk protection, but you don't really get how they work yet. It's really important to understand that if you're looking for answers from the outside, that you understand how those solutions apply to you, just as if you were doing all the work yourself. It's really important that you understand the products, that you understand the solutions, and that you're able to at least have a little bit of comprehension of what's going to be a good suitable product and what's going to be a bad unsuitable product. So we'll just look at kind of an example of what a traditional plan might look like. There's a lot of pieces to it, and that's why we tend to simplify things a little bit. Generally, you'll start with a letter to the client. You'll start the engagement with the client. You'll get an idea of what they're looking for. You'll get a copy of that letter. You'll have the table of contents that goes through every little piece of the plan. And this is all of these things set in stone in one document. You might have things like a mission statement of the advisor, principles, ethics, privacy, investment policy statement, which you'll always get, client profile, summary of goals and assumptions. They'll probably use inflation numbers, investment return assumptions, tax assumptions, a whole lot of different things. And you'll just get to all of these different little pieces, which you should be familiar with, but you may not necessarily need this giant 100, 200 page document detailing everything that could change in the next year. So you'll get things about life insurance, health insurance, long-term care insurance, property insurance, umbrella insurance, investment analysis, retirement analysis, a lot of graphs and charts, and just tons of stuff that may be super overwhelming. And again, that's why we like to simplify our process a little bit, make it a little bit easier to digest while we're still looking at a lot of things like this. I just find that these big, giant documents, while they might be good for somebody who's really detail oriented and really wants to see all of those little pieces, I find that it's much better to just really attack pain points one at a time and really just go after these simple things that everybody should have done and make sure that we are accounting for all of that. So when we talk about our simplified three-phase process of financial planning, we're breaking it up into your basic financial planning, creating your investment portfolio, and your post-planning maintenance. Like I mentioned before, you're just looking to make sure everything is in order, make sure you understand how assets are going to move, make sure you understand where assets are going to be placed, make sure you understand what those assets are going to be for, and then make sure that we're creating an investment portfolio that makes sense for all of those goals and objectives. And portfolio doesn't necessarily just mean one account. That could include all of your accounts, real estate, a whole lot of different products, a whole lot of different assets can be included in that portfolio. In fact, one of the things that sometimes we like to do is when we know that somebody's getting, say, a pension plan or a lot of Social Security, we kind of like to take that monthly payment and think, how could this sort of represent a bond allocation in the portfolio? Because we know this income is fixed, it's not going anywhere. So maybe we're able to take a little bit more risk on the other side of the investments because we know we have this fixed stream of cash coming in every single month. So when we start with phase one, which is our basic financial planning, we look at a bunch of different areas, one of them being cash flow, pretty basic stuff. We're just talking about your income and expenses, how much money we're spending, how much money's coming in, how do we think that's going to change in the future? Do we think we're going to spend more after a certain life event? Do we think we're going to spend less? A lot of different things like that. So again, really important to quantify these goals and make sure you understand where we're going to be going and how we're going to provide for them. Now, in terms of risk management, really this is just going to cover all your insurance policies. So health insurance, car insurance, disability insurance, long-term care insurance, and business liability is in here too. because you want to make sure that if you are a business owner, if you're somebody that has small businesses, you want to make sure that your structure is in place to a point where it's not putting your retirement assets at risk, it's not putting your personal assets too much at risk, and that we can really make sure that in the event of something happening with your business, that it's not going to drag you all the way down as well. In terms of tax efficiency, like I mentioned, you're not really going to get away from the taxes. You're going to have to pay them one way or another, unless you do one trick that the IRS hates, and that's die. That's the one that usually works. Then you can pass things on to beneficiaries tax-free. But other than that, really what we're looking for is we're just making sure that we take advantage of any missed opportunities. So if we have some sort of tax advantage plan that we're just not using, that we might be able to use, or we're taking income from something that's not tax efficient and we can move it to something that is, that's really what we're looking for. Unnecessary tax burdens. We don't want to have unnecessary tax burdens. Anything like, just for example, if we're looking at two different investment accounts and we're looking at one that is maybe an individual account, a trust account, something of that nature, and we have a lot of dividends getting paid, every time those dividends get paid, we're going to pay taxes on it. Even if the money doesn't come out of the portfolio, you still got to pay the taxes on it out of your own pocket. Versus if we have those dividend paying assets inside of a qualified account, like tax deferred account, like an IRA, Roth IRA, 401k, all those sorts of things, we can defer those taxes until the day that they finally come out of the portfolio. So instead of paying all of those taxes with the dollars out of your pocket as they hit the account, you'll wait until the dollars come out, and then you'll just pay your share out of those distributions. Small things like that. In terms of estate planning, evaluating the effectiveness of your current plan or lack thereof, which unfortunately we see sometimes, you really just want to make sure, again, that we have the right pathways for assets, that they're going to get to the right places in the right ways, that when they're on their way towards their ultimate beneficiary, they don't get caught on anything. They can get there nice and smoothly. Just for example, if you have, say, just even bank accounts, it's a really good idea to always just have a transfer upon death designation on your bank accounts, just because that way we know exactly where that money is going to go instantly, and the state doesn't have to get their grubby little hands in it and make it everybody's problem. Because if you have assets that don't have a designated direction that they're going to go, and they just sort of blankly land in your estate, what's going to end up happening is they'll pass through the process of probate, which ends up becoming super public. Everybody sees where everything goes. It becomes really expensive. It's usually based on percentages of all the assets within the estate. And it can take a long time. It can take 1 to 2 years in California for a lot of these assets to pass through probate. So we really don't want to let the state courts decide where things are going and how they're going to get there. We want to make our own decisions before that ever ends up happening. So that's why we use things like trusts. That's why we use things like transfer upon death or pay upon death designations, things like that, to give a direct path straight towards our beneficiaries. Yes.
With retirement accounts, I've heard with regards to the beneficiary designation, it's best not to direct it to a trust, but rather to individuals. Is that true?
Yeah, so that can be true. It kind of depends on what you're looking to do. A trust will have less favorable terms for the most part in terms of how they have to take the distributions. So, and the other thing is too, if those distributions come out to the trust and they stay in the trust, those taxes are paid at trust rates, not individual rates.
Okay.
So trust rates are always going to be higher. It's pretty significant how high those rates can be, versus if that asset gets transferred straight to a beneficiary and those payments come out, they'll pay at their own tax rates, even if it's not like stretched over their lifetime. I think it's 10 years for a lot of cases, but yeah.
And is that the same throughout the whole country, or are there state by state
I
rules
believe
about
that's just federal law.
federal?
Yeah.
Federal is
Yeah.
10.
Yeah.
Okay.
So it's the same. But
Okay.
usually you want individual, but if you have a young person that's not good with money, and they inherit it, they've got 10 years to pull it out. Well, they're gonna pull it out in 10 minutes, right?
Mhm.
So then you might say, you know what, I'm just gonna let the trust get it. And some trusts can be written into where it will take the money out, put it aside over 10 years, pay the taxes. So very good question. Most of the time, we want it going to people, because people have that 10 year, or a spouse has life, or some, there's some medical conditions that you could get it over.
Okay.
Excellent question.
But federal tax rates are higher than individual. It's not state level, it's federal level
Yeah.
for
so,
trust tax rates.
Yeah, so
Both, right?
yeah, so it'll be both. So the individuals will obviously pay both their federal and state taxes,
Mhm.
but the trust will just have higher federal taxes, period,
Mhm.
that they'll be paying.
And I think it's
Yeah.
state, if anybody's be one or the other, one, if one's higher than the other. Thanks, that, anybody know that? No attorney? To a trust, when a trust pays taxes, they're gonna pay a federal tax, but also a state tax. So do you get to write off the state tax compared to the federal? I'm not sure. I'm just gonna say you're gonna pay federal and state taxes.
Yeah.
Yeah, my question is, can you leave the money to a beneficiary's IRA, not to the individual, but into their IRA?
So you won't be able to combine their IRAs, because what'll happen is they're going to get what's called a beneficiary IRA. So they're going to get their own beneficiary IRA, and depending on what kind of beneficiary they are, they may have to liquidate that within 10 years versus their RMDs or their lifetime calculations. So their own account's going to be based on their lifetime, their life expectancy on the IRS tables. So when they hit that magical number 73, or maybe it'll be 110 by the time they get there, who knows? But it'll be based on their lifetime distributions. But if they inherit the IRA, depending on the type of beneficiary they are, if they're a sort of like the spouse, then they'll be able to get that. They might be able to stretch it over lifetime, but for the most part, the other beneficiaries will have to take it over 10 years versus their own lifetime calculations.
So I was just about to put my house into a trust.
Mhm.
So what you're telling me is it'd be better to go directly to a person.
Well, so we're talking about retirement plans.
Okay.
So that's the reason that it's important for us to talk about retirement plans in that way, is because all of the money that's going to come out of there is all taxable. So if all of those assets come out of there and all of the taxes need to be paid on all of the dollars, we would prefer that those get paid on lower tax rates for individuals
For individuals.
versus the trust. So if you're transferring assets into a trust, that doesn't necessarily mean they're going to instantly start paying taxes on the value of those assets. It's any income that comes in and stays within the trust. That's where those trust tax rates will start to affect.
Trust is not, you're already dead and gone. But if you have a living trust and if you put real estate or appreciated assets in your trust, first of all, going into the trust, there's no taxes. Then you have to sold it, right? It is registered. If I die and my assets are in the trust, then my beneficiary is going to step up the basis, they don't pay the taxes. And the benefit for you to put your house in the trust is it will get that stepped up basis. If you're married, if you have a spouse, they'll be able to hang on to it. But your beneficiaries don't pay taxes, and you have lengthy instructions. You can write a Hollywood script and say, okay, you gotta do this, you gotta do that before you get it. If you can transfer upon death, they're gonna get the house right away. So if you don't want somebody to get something, get control of it right away, definitely the trust will work on non-retirement assets. And then what Nash is talking about is retirement assets. If you leave it to somebody, we want to give them at least 10 years. If they're a spouse, then they get it over their lifetime and reduce the taxes because you don't have to pull them all out at once.
Yeah. Yes. Mhm. Yeah. Yeah, it used to always be over the lifetime of the beneficiary, but Secure Act 2.0, I believe, enacted the 10-year rule for beneficiaries, which is,
Can I follow up on what you just said? So the step up, if you give your house to a kid, she gets the step up. But
Transfer upon death, beneficiary or through trust.
okay, so if you put the title in a trust, it still gets stepped up before it gets.
And this is important,
Okay.
if you have a partner or you're married, we know a lot of people are married partnerships, and if they own a house in joint tenancy, if one dies, they get a stepped up basis on that decedent's half. But their half doesn't get stepped up, meaning go from the old price to the new price, no capital gains. And if it's a lot of gain in a big fancy house, that's a problem. So if you're legally married, at least have the house in community property, or if you put it in a trust, that recognizes or declares that this is property.
So no, if I'm not married, it goes directly to the trust via the kids.
Yes.
Step up.
Yeah, the reason you would do a trust is if you put it in the trust, if one child doesn't need it or isn't around, you've got all these different instructions. But if you say, nope, I just want them to get their share, transfer upon death, beneficiary, no control after death, then transfer upon death could work. But ultimately, if you're gonna do a trust, it's ultimately better, it's just costly.
All right.
Okay, so step up in basis, what we're talking about is when you purchase an asset, let's just say house, for example, you buy a house for $100,000. That's your cost basis. That's how much money you put in. And if the house appreciates to $200,000, now we have $100,000 that we didn't pay, and that's our capital gains. So when we have an asset like this, say we have a transfer on death designation, we say it's going to go straight to this person when I pass. When you pass and that asset is inherited, that their cost basis is equal to the fair market value, whatever somebody could have paid for that house at the time of the death. So when that asset transfers over, now the cost basis steps up to market rate, and now there's no tax liability here at all. And that's only for inherited assets. That's not just for gifts. Some people will get that confused. If you gift an asset, they maintain the cost basis that you paid for it. So if you gift that during your lifetime, they'll have to pay the same taxes you would have. But if it transfers because of your death, then it steps up to the fair market value. They could sell it that day, no tax liability at all. Okay, so now talking about investment analysis, that will also be part of our phase 1. In phase 2 is when we'll talk about constructing new investments and how to create portfolios. But here, really what we're looking to do is just see what you've got. Is it matching your risk level and the suitability for what you're trying to accomplish? So when we have different people, they'll have different risk tolerances. You might have somebody who has a really low need for income, but they have a ton of assets, probably don't need to take very much risk. It's very unlikely that they're going to draw their assets down through their retirement. But if you have somebody who has a high income need and they don't have quite as many assets right now, and maybe they have 10 years, they might have to take on some extra risk in order to try to build up their assets to the correct level in order to create that income. So it really just kind of depends on what your need is, what your objective is, and how long we've got. Those are the two things that are really important, is what's the objective and how long do we have. Those two things put together usually give me 90% of the equation of how much risk we need to take on for your investment portfolio. So the whole objective with our first phase is to create a comprehensive path forward that addresses all the concerns and all the needs to the best ability possible. We're not looking for all the easiest solutions, but we're looking for the best solutions. We're looking for the ones that do what we're looking to do in the best way, in the most concise, clear, low cost, all these wonderful things. We want to make sure that we're getting our assets where they need to be in the best way possible, not just the easiest. Sort of kind of with that step up in basis, you might just want to give an asset to a child right now, but there might be tons of capital gains that they would pay on it, and that would reduce the amount of the asset that they would ultimately receive. Versus if you allow it to transfer because of your death, step up in basis, and to keep the whole thing tax-free. Just small things like that you want to make sure you look out for, things that are not going to reduce the effectiveness of what you're trying to do, and really just make sure that we, again, get the best solution, not the easiest one.
Some people actually give stock that has a lot of gain in it, but they don't want to sell, but they give it to the grandchild who's on the tax bracket. Or charity.
Yeah, so it was something about that is it's really important to understand when you're gifting assets like that, gifting appreciated assets, understand who it is you're gifting to. If you've got 3 different kids, one of them makes $25,000 a year, one of them makes $85,000 a year, and one of them makes $500,000 a year, it makes the most sense to gift the most appreciated asset to the person who makes the least. because the lowest income levels have the lowest capital gains tax brackets. And so when you have very low income, people pay a very wonderful number on capital gains, and it's 0. I don't remember what the exact income ceiling is for that, but there is a level at which somebody could pay absolutely 0 capital gains taxes. So if you have a beneficiary or a child or something that really just doesn't make very much money that you want to gift them an asset, consider something you have that has a ton of appreciation baked in that you can now offload and make sure nobody deals with that tax liability because their income is low enough that they don't have one in the first place. So, talking about your investment portfolio. This is the type of stuff that I specialize the most in. This is the type of stuff that I find the most passion in, that I've spent a lot of time researching, and that I'm really putting a lot of work in for our firm as of today. So firstly, before we ever talk about products, before we ever talk about different levels of risk, standard deviation, beta, Morningstar, and all these fun, fancy terms and technologies, what we really want to know is your risk profile and your suitability level. I want to know what level of risk is appropriate for you, what is really going to make sure that you keep your assets, that you grow your assets, and that you accomplish your goals. And then also figure out what types of investments are suitable for you and what types of things will you at least understand enough that you can trust the process with. Like I mentioned before, if really what you're comfortable with is a few different mutual funds, a few different ETFs, all that in an IRA, tucked away, easy peasy, great. You don't need to be looking at alternatives. You don't need to be looking at limited partnerships. You don't need to be looking at real estate. If you like that simple plan and you can understand that, go with that. You can work that really hard. You don't need to try and do too much to generate extra. If you can do one thing well, that's better than doing 3 things all right. It just works better that way. So when we move to investment analysis, one of the things we'll learn how to do is how to evaluate the risk level of investments. So once we know what risk level you are, we have to figure out, okay, well now what products can I use to accomplish that? Like how am I going to build that? You say I can take on 15% of a loss, but how do I create a portfolio that's going to stay somewhere in that range in the event of a market crash? Well, that's why we're going to learn how to evaluate the risk of these different investments and what unique risks each investment can be exposed to. Because while there are a lot of generic risks like market risk, the risk that the market goes down, that's one that we're all pretty exposed to. There are other things like specific company risk. If your whole portfolio is made up of one stock, you are exposed to a lot of risk of that one stock not doing so well, versus if you have 1,000 different stocks in your portfolio. If Apple decides that they're just going to stop doing business and they shut down, you're not going to be affected that badly. So we want to make sure that we understand what type of unique risks each particular investment is exposed to and how we can minimize those and really make sure that all we have to worry about is market risk and other generic things that we can manage with our allocations. So when we get to portfolio creation, again, we go for the simple stuff. Using widely available, low-cost investment vehicles, design a diversified portfolio satisfying your needs. We don't need to spend a ridiculous amount of money on products that are supposed to deliver some sort of promise that we don't know whether it's going to work out or not. We just like the tried and true, simple stuff, stock funds, bond funds, maybe a little bit of active management here and there, but we really like low cost because often what we find is a lot of these high cost products don't actually end up outperforming the low cost ones that much at all. And then you end up paying this giant fee that eats into your profits even more. And it just really can be a negatively compounding game that puts you in the wrong place. So we like low cost stuff. We like inexpensive stuff. We just like to get the stuff that we know works, the big products, Vanguard, Fidelity, Schwab, all those big companies with super cheap funds. We just like to use those because there's not too much need to do too much more, except for on small percentages. Yeah.
When you say cost, what do you
So that depends. We might be talking about the expense ratio of a mutual fund that we'll talk about later, the fee that those managers charge. We could be talking about commissions. We could be talking about advisor fees, where if you're paying 2% a year for somebody to just build you a portfolio and then let it set and forget, that might not be worth it, versus you could pay maybe 1.5% for a firm that does more work. There's a lot of different costs that might be associated with different products like this, but for the most part, we're talking about the management fees from the funds themselves. So our objective with this phase is to achieve your goals at as low of a price as possible. We want to pay as little as possible, except for when we want to really just trade time. That's the only thing that we're willing to pay a lot of money for, is to get our time back. So paying for a product, I want to pay as little as I can. It just doesn't really make that much sense to pay a lot for a product. I want to pay a little for a product, especially if they're going to do almost the same thing. Now, if I'm paying for my time back, I'll pay a premium for that. I'll let somebody else take over something if I know they're doing the right thing. But for the products and the solutions, we want a low cost, while at the same time protecting your assets from all substantial risks as much as is possible, or as is reasonable. So we don't want to protect against too much risk, and now suddenly we can't finish our goal. We can't actually fund the things we want to fund, but we want to make sure that we're not exposing ourselves to anything unreasonable, that we're not putting really extending ourselves too far beyond what is reasonable for our goals.
Say,
Yes.
to get our back, you mean as like active retirees, we don't want to be doing all the work that you advise.
Yeah, exactly. And even sometimes as professionals, like there might be things that we just don't specialize in, that we would rather have somebody else do than spend a whole bunch of time to do in a mediocre way. So it just really, especially as a retiree, as somebody who probably wants to spend more of their time retired than, working a job for your own IRA, you might want to end up giving some of that capital over so that you can get your time back and you can spend it reasonably. Yes. So from a Roth IRA, there's no required distributions that you have to take at all. So there's an age you have to hit first in order to be allowed to take distributions, but there's no point at which you'll be forced to take them. You can leave the assets in there as long as you like. You can contribute as long as you have earned income, so something like a job or some kind of W-2 income or ordinary income. Yeah. Sure. Yes. Mm-hmm. Yes. Yeah, you can do conversions without any earned income. That's not a requirement. And you can also do it to as big of an amount as you want. Or I think, is there a top limit to conversions?
There probably is.
Yeah, you just have to pay taxes on it because you're taking it out of a deferred account or out of a type of deferred account, paying taxes on it, and then pushing it into a different type of deferral. Yeah.
If you believe taxes are going up, then sure, you can see your accountant, run the numbers, start converting over the next months or years or whatever. But if you don't believe taxes are going up and you're not going to be in a higher tax bracket, why would you pay all the tax on that? Who do you benefit the most when you do a conversion from? Anybody think of benefits? Beneficiaries. Yeah, you pay the taxes for them, right? Same with long-term care. If you don't have it, don't pay for it. But if they want to protect your house, then they can pay for it, right? Or not. If they don't come visit you, think, well, I might get a reverse mortgage because I need to hire some people to visit. So I go, no. You don't want a mortgage on your house. Wait, yeah, but I'm here all by myself. We'll come visit. We'll come visit.
Yeah.
Yeah.
Yes.
Is there still required distribution in the Roth?
For a Roth, no required distributions from a Roth, only from a regular traditional IRA and 401k. So when we move to phase 3, which is, I would think, one of the most neglected parts of financial planning, period, for a lot of people, because like I mentioned before, they like to think they build all the assets, they get there, now we're done. Now just kind of spend it until it's gone or until I die. But there's a lot of things that you will want to do, like investment monitoring, making sure that the portfolio continues to meet the objectives. There might be things that change, or as we get closer and closer to taking money out, or we are taking money out, and we want to adjust our allocations to something that's not going to fluctuate so much, that's something important that we want to look at. If you're looking at something like a Roth IRA and you don't plan on taking any money out, let that puppy ride. Let's go equities. Let's let it grow. Get that tax benefit, especially for beneficiaries or whoever else is going to take that out. Let those assets grow as much as possible. But if we're required to take money out and we're getting to that age, maybe we're turning 73 this year or something like that, and we have a lot of assets that move up and down a lot, we might want to start toning sections of that portfolio down to something more stable so that the dollars that we're pulling out are not dollars that are likely to have just been down 20%, and then we capture that loss, take it out, and miss out on the upside again. So there are a couple things you want to do to make sure that you're keeping your portfolio in line with what you're trying to do every single year, every single decade, continuously for the rest of time. Regular plan revisions. It's always good, even if you don't need to make a change, to always look at your plan and check. Maybe you do, maybe you don't. Maybe there's a beneficiary that you don't really like as much anymore, and you think maybe you could push them to the side and reallocate for everybody else and make their lives better. Or maybe you just have somebody, again, like we mentioned before, that you don't really trust with $1 million. So maybe you want to make it a little harder for them to get there. That might be something you want to write into your plan and not just go, here you go, buddy, good luck, and then it's gone in a year. Because that happens all the time. I mean, you just see things like, it's shocking how many people will win the lottery and instantly be broke, just so fast. They have no idea what they're doing with that kind of money. And that can happen a lot with our beneficiaries as well, because they didn't spend the 30, 40, however many years building up those assets. They don't have the same perspective. They don't have the same ideas of how to manage it. Not all of the beneficiaries are going to grow up to be financial advisors and have a good idea of how to manage those things. Some of them are just going to be people who don't really know that well or don't understand the risk that they could put themselves at if they spend those assets down too quickly. So there's a lot of things that you want to make sure that you're checking on your plan, making sure that you're taken care of, making sure that your beneficiaries are taken care of, and making sure that everything stays on track continuously. Awareness of laws and regulations. It's boring, it sucks. Even we don't like doing it a lot of the time, but you got to stay up to date on what's happening. If you're going to do this yourself, you got to make sure you know, do beneficiaries still get the stretch IRAs? Not anymore. Now you have to be a very particular type of beneficiary to keep that distribution over your lifetime. Otherwise, it's going to be 10 years. And if you don't hit those 10 years, boy, are you going to start paying some penalties. And it's going to start looking really bad for the value of that account. So it's really important to stay up on things that are pertinent to you and make sure that your plan still works, because there are a lot of plans that people do that are beholden to particular laws and regulations and maybe little workarounds like mega Roth conversions or stuff like that. You never know when the IRS is going to suddenly go, we didn't really like that thing that all of you have been doing for the last decade, so we're going to retroactively say that wasn't allowed anymore, and now you got to go back up, make up for it. You just want to make sure that you are really staying up to date on everything that's happening, and if there are things you want to take advantage of right now before other laws are passed, whatever it is, just make sure you stay up to date on the things that apply to your plan and even some of the things that don't, because some things can just adjacently or tangentially make a little bit of an impact that changes the probability of your plan moving forward. It's very complicated. It's very boring. It's a lot of reading, but it's really important. So our objective here really is to maintain a plan that continues to fulfill your objectives, even as your needs change, as well as maintain awareness of the regulatory environment that affects your plan directly. Really important. So what sort of stuff are we going to do in these phases? We talked about the concepts and some of the things that we would talk about and all this sort of stuff. So the way that we like to do it is we like to use things that we call diagnostics. It's really just taking a look at a bunch of key metrics within these different sections of your financial life and making sure that they line up in a way that makes sense for you, that you are going to be able to take moving forward, and just make sure that you're not at any unnecessary risk or anything like that. So personal cash flow, just make sure that you know where your money's coming in, you know where it's going. This is something most of you are probably going to be pretty good at. I imagine most of you have a decent hold on your budget, so we won't spend too much time talking about that. But it is important that if you're not aware, be aware. It's just really important to be aware so you understand that if things change with your assets, you understand how that's going to affect your cash flow, especially with distributions, Social Security, pensions, all that sorts of stuff. Really important to understand.
Type of cash flow. Sorry.
Expense or revenue?
Expense.
Oh, assisted living, needing help at home.
Right, we don't want to hear it. I have a long-term care policy, but when you really look at it, it's gonna cover about a fourth of it all. And so our job security is you can't afford to spend all your money. You have to keep it invested and grow every 5 or 10 years. The cost of healthcare goes up. So that's a future cash flow item. Back of your mind, just think your assets, be self-insured and or insurance. But that is a fund that it can really go up over once.
And I think I heard somebody mention Social Security as well. For most of the people in this room, that shouldn't be too much of an issue, but it might be something that I'm worried about. Is that going to be a concern moving forward? Is Social Security going to stay funded for my retirement? Probably not. It's not looking good. It's already looking like it's going to run out in not very long. So that's something to really keep in mind if you have, especially younger beneficiaries. They probably are not going to be able to lean on Social Security like a lot of clients currently are able to or previously have been. There's a lot of concern that there's just not revenue to go in to pay for it. They've been on a negative decline for a long time. Who's to say how tax rates are going to change? What's going to happen? I think they should just uncap the Social Security tax. I don't really understand why it stops at $166,000. Why not let people making 500,000, 7, a million, 2 million? Why not let them pay into it? I don't understand what the point is. Anyway, that's a conversation for another day. But there are things like that you just, depending on your stage of life, some of these things might be a concern, and maybe you don't plan for that as an income source. And if you get it, wonderful, a little bit of extra spending money, and that'd be great. Yes.
Well, you raised an interesting point about Social Security. I've been out of the country for a while, so I haven't been following. So there's a likelihood that even though I've been paying into Social Security for the past, 40 years, that I may not get a Social Security payment. And if that's the case, if I decide then to immigrate to another country and renounce my U.S. citizenship, the U.S. government can't then continue to tax me on my other income, right?
Yeah. So if you completely remove yourself from the United States and like completely denounce your citizenship and all that, you won't be paying U.S. Taxes anymore. If you have something like a dual citizenship, you will, because they really want to get their hands in it. Yeah, they want to get you every which way. But if you really completely disconnect, then you should be able to escape that taxation. Yeah, exactly. But yeah, it's not, we're not thinking that within the next few years or maybe the next decade, but it's something to where as we move forward, the likelihood just gets stronger and stronger for the next generations moving forward. So anybody let's maybe collecting now or is looking to collect soon, I don't think it's a super pertinent issue right now today, but it's something that next generations just probably shouldn't count on. That's kind of where my head is with that.
Grandkids are your kids. You're going to be okay, but they're going to come up with different little, hey, we're going to give you this. Isn't this a great thing if you give this up? But if you're under 30, be concerned. Over 40 to 50, maybe beyond that, I don't see you taking it. Nash and I came up with a plan. I won't bore you with the details, but they tax you all the way up, and then you could either add your own money to it and increase your retirement annuity, because that's the only Social Security. Then if you die, the pool gets it, people get it, and then rich people pay a fortune, but they pass on getting it, but they can get tax credits, so they can sell real estate, sell pensions, and get money moving around. So that's on the website. Yeah, I'm not going to let him run for president.
Yeah, so just continuing on stuff like insurance, again, we mentioned that, you're probably pretty well protected on stuff like medical insurance, auto insurance, things like that, but just making sure that our coverages are as maxed out as they can be, especially for what we can afford. Because when you get to a certain point, when you have assets built, losing those assets is a lot more painful than paying a little bit of premiums every month. So things like making sure that on our auto policies that we're maxed out as much as possible. If you have something like an umbrella policy, they're going to require that anyway, but also making sure things like underinsured and uninsured motorist coverage is there, because there's just those chances that you just don't really want to take, especially if you're not adding too much to these assets anymore. If you're not growing them so much, if you're just at a point where you're living off of the nest egg, protection is super important. Even if it crunches your cash flow a little bit, it's really important to make sure that we're not putting hundreds of thousands or millions of dollars at risk at any given time. Yes. So an umbrella liability policy, you can kind of think of it this way. You'll have all of your little specific policies like auto liability, homeowners liability, and those sorts of things, but they'll cap out at a certain point. Might be $500,000. You might have $3 million of assets. So if somebody gets injured on your property, or God forbid you kill them in a car crash and their family sues you, say they want $5 million, that auto insurance policy will only cover up to its cap, and then it's done. Then they come after you personally. They go for your assets. So with something like a umbrella liability policy, the idea is that it's trying to cover the rest of your assets that might be vulnerable, but that are not covered by auto, they're not covered by homeowners, so that once those policies are tapped out, this one will kick in and then will make up for the shortfall. Now, one thing to remember is $1 million umbrella policy is not quite $1 million umbrella policy. It's $1 million minus whatever everything else covered. So if you got 500,000 from the auto, it's going to be an extra 500 for a total of $1 million coverage. So that's the basics of an umbrella policy and why you might want it. And your assets might be protected, but it's just better to be safe than sorry with a lot of these things, just to make sure, God forbid something really bad happens and a big suit comes your way, that you can protect your assets and that company can pay out for you. Yes. Yeah.
Your retirement fund, your deferred comp things or something like that.
Yeah, there will be some select assets that are protected, but it's just something to review and make sure that you stay really up on, because otherwise any individual brokerage, real estate investments, businesses, all that kind of stuff, you want to make sure you're covered. Yeah, your home as well.
Talk about rollovers later in the class. You don't want to roll over 401k or deferred comp into an individual IRA because you could lose that lawsuit.
That's what it was.
Yeah, I can.
Just to keep doing that, we're like, careful, because we've lost that protection
Yeah.
now.
I can touch on that really quick. So what we're talking about right here is ERISA protection, which you'll find with qualified plans like 401ks and other plans like that, profit sharing plans. And so when you decide to roll those over to an IRA, you want to be really careful with that rollover. Don't ever roll over an ERISA protected plan into an existing IRA. And the reason why is because when you roll it from that ERISA protected plan to an existing IRA, it's all considered assets of the existing IRA and it loses the ERISA protection. Now, why do we care about the ERISA protection? Because that's protecting us from creditors and suits, because it's saying it's for our retirement. Even though an individual retirement account is for your retirement, it's not considered protected under this act. So I don't remember what it stands for. You remember?
Employee Retirement Insurance Act. So your money built up in a 401k, deferred comp, or something, an official retirement plan that is covered under ERISA, meaning that you can't lose that in a lawsuit. So you want to be careful to not combine that with a regular IRA that is or isn't, and regular IRA is or isn't based on how much you might need to live on.
Yeah, you'll just want to assume that your regular IRA that has nothing to do with an ERISA plan is not covered. There's some limits that it goes up to, but you just want to basically pretend it's not covered and don't roll any assets into that because there is a maximum. Now, what I will say is if you roll over an ERISA protected plan into its own IRA or only with other ERISA plans, it will actually maintain the same level of protection as an ERISA plan will under some California Bankruptcy and Creditor Protection Act. So it'll give you the same level of protection as ERISA does. It's not going to be ERISA protection, but it will be the same level if you keep it separate from existing IRA accounts. So if you're rolling over 401ks, any other qualified retirement plans, keep them separate in their own IRA, away from any existing IRAs so you don't lose that protection. Super important.
Remember, we had state protection for 100,000. After the fact, homestead your house. That's moved up to like 650. So if you don't have a lot of other assets, you have an ERISA protected IRA, they can't take it. If something happens, your house has homestead protection up to about 650. That's new. So that's next year.
Yeah.
So you may or may not have to buy the real policy, but you need to look at it.
Okay, so continuing on, stuff like estate planning. Obviously, like I mentioned a million times already, making sure that we have the right channels for your assets, making sure they're going in the right direction, make sure nothing gets kind of just left to the probate courts, because we don't like probate courts. We want things to go according to our wishes in the ways that we desire, privately and efficiently and cost effective, versus probate, which will be, like I said, very public, very time consuming, and very expensive for your estate. Things like taxes, just making sure that we're not doing anything ridiculous, that we're not generating a whole bunch of capital gains for no reason, that we're not distributing a whole bunch of dividends and capital gains to taxable accounts when we don't need to be, that we're just using the proper methods that we have available to us. Again, we're not really going to evade our taxes, but there are things that we can do to be a little bit more efficient or make sure that we're using the right channels to just make sure we're only paying just as much as we're required to and not a cent more. In terms of portfolios and investments, really just assuring that everything is in line with what your plan says, that you're not too risk on, or you're not too risk off, or you're not too exposed to any individual little risk. Like if you're only in Germany stocks, if Germany doesn't do so well, you're not going to do so well. If you're only in tech stocks, if the NASDAQ does what it did recently, you're not going to be too happy. Stuff like that, just making sure that you're not exposed to any individual risk too much, but that you're exposed to all of them on a really low level. So, portfolio construction, these are just some basic concepts that we'll explain now and get in depth with later. But the way that we like to simplify the portfolio construction process is to think of everything. We really just like the number 3. It tends to cover bases. It simplifies things. So in terms of lateral integration, there's 2 factors that I want to take into account. How much risk you want to take and how much time you've got left until you need to use your assets. So when we start all the way on the left, we're going to think of assets that we are going to use soon. What are things that are most likely to come out in the next couple years? We want to make sure those are stable assets. We're not going to put all of that into Apple stock and then have Apple crash by 50%. And now what was supposed to be our distribution is half what it was. In the middle, we might have things that are a little bit of growth. Maybe they're generating more income for more risk, whatever. We're just increasing risk as we get further along in our portfolio. And the expectation is we can wait longer to take those assets, because the more time that we have to wait, the more risk tends to sort of average out and give you a more favorable expected return. We'll talk way more in depth about those things later and why that's the case, but just understand the basic concepts of the longer you have, the more risk you can take, and the less likely it is that it's going to affect you in your plan. Vertical integration is really just kind of our fancy way of saying diversification, making sure that you're not too exposed to any one individual thing, and making sure that we are creating a portfolio that biases on low cost investments, which will be the largest portion at the bottom. And as we move up, get maybe a little bit more specialized, get a little bit more concentrated. But the more concentrated and more specialized we get, the smaller the positions get as well, because we don't want to overexpose ourselves to those specialized risks. So something might be a sector fund. Maybe we are feeling favorable about technology. Even if we are, I'm still not going to make all of my equities technology funds. I'm going to make it a small portion of the portfolio and make a tiny little bet on maybe 5%, 3%, maybe all the way down to 1%, depending on your risk level. I'm going to say, I feel favorably about technology, but I'm still only going to put a little tiny bit of my portfolio in that, maybe generate some extra returns, maybe not. And if not, it's not the biggest deal in the world. So those are just a couple concepts that we'll get way deeper into later. We'll talk about way more confusing and complicated numbers that explains the reasons for all of that later. And phase 3 with monitoring, really we'll just be going back on all of these things that we talked about, making sure that your investments match your risk levels, making sure that your risk level is either the same, or if it's changed, that we change the plan along with that so that it matches. We always want congruence between you and your plan, even if it's just you changing emotionally. That's important enough to change a plan to me. If it doesn't mathematically completely throw you off and you can take less risk and that makes you feel better, do it. There's no point not to. It's not that important to squeeze every single little dollar out of every single one of your dollars. What's most important is to succeed and feel good about succeeding. Point blank, period. I want high chance of success, high chance of you feeling good about what you're doing. Making sure that your allocations stay in line, super important. That's stuff that we'll talk about. Distributions, making sure that if you're required to take them, you're taking them. You're not paying penalties, you're not paying interest. That if you are taking them, you're taking them from the right stuff. You're managing it, making sure you know where that's going. Estate planning, reviewing your designations, because you never know, something might have happened to one of your beneficiaries. Or, like I mentioned before, you may have had a little bit of a falling out. You may not like them so much anymore, and maybe you need to change and you've just forgotten. You might have some life insurance policy you just don't really think about too much anymore. Check and see where that's going when you pass. You might have just your bank accounts. Make sure that they're going to go in the right place. If they're just going to go to your trust and that handles it, great, fine. If you have somebody that you want to just take over, make sure that transfer on death is there so that all your assets move quickly to their destination and they don't lag or get caught in probate. Reviewing your trust documents is really important because oftentimes what we'll see is we get to a point where the trust fulfilled the goals that we were looking for a long time. And then at some point, the goals changed. At some point, what we wanted to do changed, but nobody did the work of changing the trust to reflect that. And then suddenly the people who had that power lose some of their cognitive abilities. Now they can't change it. Now we're beholden to those original trust rules, and it just doesn't fit. So making sure that we understand all the time that our trust documents are in line with what we want today, tomorrow, and next year, that continuously they fall in line with what you want all the time, is really important. We don't want you to end up in a situation where now stuff is happening not the way you want it, and there's not really anything we can do because the people who would be in charge don't have their faculties or for whatever other reason.
A quick story. Doesn't have brothers or sisters, mothers or fathers, children or friends. He's got one or two friends. His mother has been a client 30 some years ago, and now he has a trust and we manage it and we take care of him. But we're starting to pay his bills for him and things, and our compliance department saying, that's enough. So we went out and got a private fiduciary to pay the bills. He has a tax person, and we brought in an attorney. So he has all these people working for him. But the beauty is that if he has issues, the state's not going to kidnap him and put him in a facility and take his house and his assets. I have another client where they did that. They took the person and she had to go in a facility. We still get to manage the money. She has a trustee, but now he's protected. He could forget to pay the bills because they're being paid. And because he doesn't have hot water right now, we'll get somebody to come in and he's a bit of order, things like that. So follow all these things, but ahead of time, not after. Because like Nash said, if it's too late, then you've got to deal with the old stuff. And plan ahead of time as that when you're in perfect health and everything's great, that's the time to do this stuff. I started doing a will and a trust when I was Nash's age. So I didn't have much to do with, but you just want to remember, and it's possible you can do a trust online if it's a simple situation. Next step is a paralegal if you're willing to pay somebody, or if you have a complex situation, you're gonna have to pay 3,000 to 5,000.
So keeping up with the times, like we've mentioned before, staying up on those regulations and staying up on economic news. Not that you're going to be able to change your allocations and perfectly follow trends and make more money than everybody else, but just understanding that if things are getting a little hairy in certain sectors, maybe you want to pull off a little bit. So the one that we watch the most has to do with interest rates, because we notice a lot of funds, especially balanced funds, things like that, will end up invested in a lot of long-term bonds. And when interest rates start to change, interest rates start to go up, long-term bonds, because you're locked in for 10 years, 20 years, 30 years, now suddenly you're getting 1% less than everybody else can get on a 5-year or a 2-year. The value of your bond just crashes, because who's going to want to pay the same amount of money for a 2% or a 3% if they can go out and buy a freaking T-bill at 5? There just would be no point. So that's one of the main things that we're looking at, is what's called duration risk. Very complicated calculation. We'll explain that later, but essentially it's just how sensitive are my bonds to interest rate changes. So when we see things like, interest rates are just super flat and they look like there's probably at some point going to start rising, we want to really keep that tight so that when the interest rates start picking up a lot, our bonds are not crashing to the floor like we saw with a lot of funds and a lot of companies and a lot of model portfolios did when the interest rates really started to pick up. That was a really rough time for a lot of positions in some of our accounts and in a lot of accounts across the board. Yeah.
I think it's the best place to look up to keep up in time. I know you sense it.
Yeah.
Great, but not everything.
Yeah, one of the sources that I like to use a lot is Bloomberg. They have a lot of really good information. I like some of their TV programs and radio programs, podcasts. Morningstar has a bunch of stuff like that. And a lot of the big investment firms will also put out a bunch of their research. So just listening to some of their thoughts, their fund managers might have very strong opinions, but really just listen to what are the reasons why they think that, not necessarily their conclusion, but like what are they paying attention to? What are the things that, might influence me? So big companies like that, Morningstar is a favorite. We like a lot of the stuff that they put out. They've got a lot of podcasts. Bloomberg is a favorite of mine. Do you have any others that you like to?
Later, when we're into an ETF.com, a lot of stuff, when you get to the intellectual ETF investors, we'll send you this podcast that are pretty good, fun to listen to, and they're not too complicated.
Yeah. And then, of course, there's the most entertaining, most fun source of information possible. I just read this one for fun on the weekends, and it's the IRS website. Yeah. There's a lot of notices that come out. I mean, everything about the Secure Act has just been notice after notice after notice, because Secure Act 1.0 came out and we were like, okay, that seems kind of confusing, but we kind of get it. And then they put out Secure Act 2.0. We went, okay, some of that makes sense, but what about these things here? And now here's a notice letter, here's another notice letter, here's another notice letter. And there's like 10 different documents all clarifying the same rules that we've been confused about for the last decade. So a lot of stuff like that. I think we're just going to skip through these things because we've made it to the end of our session here. We just got a class outline up here. Same thing as you have in your brochure. Bunch of stuff that we'll talk about. We'll get a little bit more in depth to some of the things that we talked about in terms of our phase 1. We'll talk about that next time. A couple of the things that we can go over. We'll just start getting into more details. But other than that, that's all that we have for today. And if you have any questions, please feel free to stick around and ask anything you'd like. We'll be around for a little bit.